Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
Hello folks, welcome back to the Property Couch podcast. Hello to you too, Ben.
G'day mate, how are we going?
Very good. Unique.
We're back.
We're back.
What, social distancing? But,
Socially distanced in the studio
Victoria,
here.
the Iron Curtain has been dropped. You're allowed to come back to Melbourne.
So folks, if my audio sounds rubbish, we can't blame the Torquay internet, we have to blame the Stig. She's over, you just might have heard her then, she's tweaking the little controls over there. But looking forward to today's podcast, Ben. Should we give a little sneak peek on what's coming up?
It's a masterclass, that's all I'll say.
Okay, little sneak peek.
I've been so thrilled to have this person on.
Yeah, super. Folks, stick around. You're about to get some awesome property information from someone who's been doing this for a very, very, very long time. But before we get there, Ben, I just want to talk about a couple of things. We are in the middle of our course launch, Start and Build. It closes this Sunday at midnight. And a couple of times a year, what we do is we do a launch of this particular course where we give it at a very significant discount. So we can get it into the hands of as many people as we can, because it's a visual way for people to understand how to create $2,000 per week passive income. But not only that, Ben, because we talk about 2,000 all the time, but there is a case study in this course to show how to do 1,000 as well as 3,000.
Awesome.
As well as the signature 2,000 and the mechanics. And it's over the shoulder with you. That's just one of the bonuses, Ben.
Which is on demand, right? It's on demand in terms of where you're able to slow it down. What do they mean by that? And it just reinforces at that next level all of the teachings that we deliver.
We do. So we always talk about the do-it-yourself is for the podcast, and then some people want it done for them, which we're happy to satisfy within our business. But some people want to do it with you, and that's where we see what this course goes in. So if you want to go to thepropertycouch.com.au/start and build, and the and is A-N-D, Ben, just for the avoidance of doubt.
Good to know.
Start and build, so /start and build. Go there, check it out. There's some videos, there's some students there. You can see their experience. You'll see exactly what you're going to get. Certainly want to encourage you. But folks, it's on this significant discount leading up to this coming Sunday at 11:59 p.m.
Show's over.
After that, it goes back up to the normal price. So that's super. Now we're going to give away some courses too.
We are.
So people who have been very, very kind to give us some reviews on iTunes. So this one's from David Esky. Started listening from episode 1 at the start of COVID and have just caught up. A truly binge-worthy podcast that constantly delivers gold and doesn't disappoint. Just used all your fundamental principles. Here we go. This is so exciting. Just used all your fundamental principles to purchase my first home. Hello. You even got a Stig round of applause there too, which is rare. So thank you, Ben, Bryce, the Stig. You got it in capitals there, Ivis, and Emma. So there's a course. So David, please reach out to us. We'll give you access to that. Zen 101, good name. Excellent podcast, 5 stars. Really informative, light-hearted, and terrific insight into the current Australian property world. Thank you for that. Zen, let us know. Reach out, info@thepropertycouch.com.au. We will give you free access to that. This one's, and just so you know, there was no 1 or 2 stars in the last little ones, Ben. So just,
very nice of those people.
If it was there, I would have read them out. Top
We're not
shelf.
encouraging them, no, Bryce.
We're not encouraging them, just saying that it's an equal opportunity readout. So top shelf 5 stars, like a nice wine from the top shelf that's getting better with age, starting at Ep1 and powering through. The more you listen, the more you learn, and the better it gets. Think start to click, and before you know it, you're in a position of power. Brendad.p. If that's you, Brendad.p. Reach out to us on the final one. Excellent podcast, 5 stars. I stumbled across this podcast and it is very informative, and I'll continue to listen every night. Thank you. And that's from Miffy S 1890.
Okay.
So hopefully that's not the date of birth, Ben.
Got to prove your identity back to the name.
Yes.
Yeah.
Well, 1890. Ibis goes, why?
Well, that's public. It's in the public.
Yes.
So you're only reading out what's available for everyone to see.
Now she wants to know why if the date of birth is 1890. I'm thinking because you've got some vintage on you. So Miffy S 1890. There you go. So check that out, folks. And the last bit of housekeeping for me before we launch into our very special guest, Ben,
Yes, mate.
is summer series. Ibis has locked in all the guests. It's
Wonderful.
super exciting, Ben.
It's a lock.
Because she does a very good job, Ibis, of making sure there's a good cross-section of people, different age brackets, different experience levels.
Excellent.
So the reason I want to share that at this point is because I understand that if people are avid listeners to us all throughout the year and then they go on holiday, sometimes you just need a change of headspace. You might try a different podcast.
Yep.
So what I just want to say to people is the reason we're doing this is it's a deviation from our normal format. There's no massive intro, there's no massive conclusion. It's just going straight into transformation stories.
Yep.
Very easy to listen to. So if you are going down to the beach or going away on holidays and you just want to listen to some really good stories to set you up,
Get some motivation
for 2021. Just letting you know, it's not just rinse and repeat on what you've been doing for the last 50 weeks whilst you're not on holidays.
Yep.
There is a bit of a difference. So
Beautiful.
hey, my Mindset Minute theme today is, Ben, this will come as a surprise to you, but I'm continuing the journey through the How to Win Friends and Influence People book.
What a surprise.
I saw that look on your face. Chapter 17.
I didn't know where you were going with that, so I'm like,
I saw that look on your face. I'm thinking,
where's this going?
yeah, well,
Well, I thought we're still in the book.
lost in translation over the net. So chapter 17 is a formula that will work wonders for you. I'm going to say it again, that the gold is in the stories in the chapter, the principles, the way that you get it to land, but I'm just going to give you the highlights. So remember that other people may be totally wrong, but they don't think so. But don't condemn them. Any fool can do that. Try to understand them. Only wise, tolerant, exceptional people even try to do that. There is a reason why the other man thinks and acts as he does. Ferret out that reason, and you have the key to his actions, perhaps to his personality. Now, I've said this before, his and her substitutes,
Yep.
It was written a long time ago.
It was.
Try honestly to put yourself in his place. If you say to yourself, how would I feel? How would I react if I were in his shoes? You will save yourself time and irritation, for by becoming interested in the cause, we are less likely to dislike the effect. Think about that for a bit of wisdom.
Sense.
Here we go, we'll bring it home. And in addition, you will sharply increase your skill in human relationships. So, if as a result of reading this book or listening to my highlights of the book, Ben, you get only one thing, an increased tendency to think always in terms of other people's point of view and see things from that person's angle as well as your own. So here it is, principle number 17. Try honestly to see things from the other person's point of view. Ben, now that leads into my life hack a little later on because I try and see things from your point of view on one particular topic specifically.
US election?
But I will.
Oh no, I think it'll be something else.
I think it'll be something else, but I'll carry that over to the life hack. So stick around for that, folks.
Rightio.
But hey, we've got a really special guest. Props to you. You have been trying to get Jock onto the podcast for some time, and you were able to do that. But we recorded this a little early, but I think we should set this up because Jock had an enormous amount of wisdom in the conversation. But I want to encourage people to lean in and press into this conversation because Jock was a little quiet early on and his hands were moving all over the table and tapping the table to emphasise and all those sorts of things, which just makes Iris excited when she's editing these podcasts. But I'm sure you'll agree, Ben, that if you lean in and you remind yourself that you're about to listen to someone who's been doing this for an extraordinary amount of time, if you let the wisdom land, if you let the lessons land, and if you just let it sink in what he has to say, boy, oh boy, oh boy.
Oh look, 5 decades and before that being a stockbroker, oh boy. So let's cut to the interview with Jock Bing.
All right, Ben, we've got a very special guest today on the Property Couch, but some significance for you. So I'm going to let you do the intro today.
Well, thanks, mate. I appreciate that. Look, Bryce, there's been some amazing opportunities that we've had over the journey in our business, and also prior to setting up our business, there were people just like everyone who's listening in the community today who might be beginners. I was a beginner once, and there was a lot of direct research that I did. There was a lot of sort of events that I attended back in the day, and I've seen the spruikers and I've seen the A-graders, right? And obviously throughout the course of that program, I've had virtual mentors and then actual mentors. So good example, Scott Keck, right, who we had on the show, an amazing masterclass. But there are other people in the industry that I've admired from afar, and I've also got to meet over the 20 plus years that we've been doing this, right? So, we started in 2007 and we've been developing out since that time. But what is amazing about some of the people you meet in this industry, well, I'm about to introduce you to one of the people who I rate one of the highest producers, as one of the best leaders in our industry, and most people wouldn't have a clue who he is. But I want to introduce everyone to Jock Bing. So welcome for joining us, Jock. And I just want to go through some of your highlights, right? Because this is quite incredible. And I've been honoured to be able to get to know you over the course of the last few years in terms of some of the work you did. So in 1967, you founded a business called Portfolio Management Services with another partner. Prior to that, you're a stockbroker. And I want to come back to that story in a minute. But I just want to talk about some of the results you've been able to achieve for your clients, because they are simply incredible. So considering that you were buying properties in the early 70s and the 80s and 90s and into the 2000s, it is an incredible story. In fact, Charter Keck Kramer from, obviously that great man Scott Keck, his firm, did a review, so an independent review of the properties that you bought up until 2002. So this is a 30-year review of your performance. Unbelievably, an ungeared return, so this is without leverage, of 17.7% per annum for the portfolio of properties that you bought. In terms of with a geared strategy, that return increased to 22.5% per annum on a 66% loan to value ratio. Now, when you compare that to other indicators such as the All Ordinary Index, the listed property trusts, both the Melbourne and Sydney Property Index, you outperformed every one of those markets. In addition to that, and this is quite interesting, is whilst the rating, you rated second lowest in terms of risk and volatility, and you were only beaten by the 10-year Treasury bond. So this is a low risk, high return strategy. Now, I haven't finished yet, Bryce. This is how important this introduction is to one of the legends of our industry. In 2019, so that's a 2002 result. In 2019, 47-year review of your portfolio of every property that you and your team had bought. And this was done by Atkinson Consulting.
Yes.
And you looked at the Brisbane, Melbourne, Geelong and Sydney properties, a total of 1,128 purchases, and you achieved a capital growth annual return, compounding return rate of 8.3% over those 47 years. Now, compared to the REIA, the Australian Real Estate Institute of Australia, their property index, they had a 6.2% capital growth return. So you outperformed them by 2.1%. On a yield basis, you're on par, about a 4.7 across the board. Now, your overall return and how this slightly adjusts for those numbers, so if people are trying to understand this, there is some variation to this, but overall, you had a 12.6% compounding return over 47 years compared to the Australian property market, which was 10.9%. So you've outperformed the marketplace by 7.1% per annum, which is an extraordinary result. And that's why I am so thrilled to be able to introduce you to the Property Couch community, because we want to unpack that story. We want to get to understanding what it is you did, what was the science behind what you did, and we're going to start with the backstory, Bryce.
Yeah, well, first of all, welcome, Jock, to the Property Couch.
Thanks, Bryce.
Now, you started that business back in 1967, and you're now the Executive Director and CEO, as Ben said, of Portfolio Management Services. But I'm keen to like that's a pretty big build up, and I'm certainly looking forward to unpacking that.
Paid money for this.
Yeah. Well, there was a side deal on that, was there? But I always, Ben and I have been privileged to speak to people who have got longevity in the game. Because you speak to a lot of people who might have been in it for 10, even 20 years, but we've been really fortunate for people, a number of people on this podcast have 20 plus year histories. Well, your history is in excess of 40. So, but before we do unpack that, can you sort of let us know what it was like back before 1967, before you started the business, and how fate, chance, or planned luck got you into the property space initially?
Yes, at that stage I was an advisor with AC Good and Company stockbrokers, and I was situated in Sydney, and I realised that there was a real opportunity to buy inner metropolitan properties, residential, in that area. And in fact we did, we bought a number of them, just as a few of us, and it turned out to be a really fantastic idea. And then when I came back to Melbourne, I thought this has got to be achievable here, and it was for that reason we then started to put portfolio management into the market. At that stage we never had a property market of any sort.
There was no industry. There was no property investment industry, was it?
I had a partner, and he was a share broker, a share sort of advisor. And I said, why don't we do this for property and make it the same, as easy to buy a BHP share as it was to buy a property? Well, that's bullshit, of course. It doesn't work that way. But the point was that the scenario of doing this with rules and regulations as to how you do it, as long as you stuck to the rules, that it'd work. And he decided that he'd probably have a number of his clients that might do this. And I knew that I had a number of clients as well. So the concept of at that point the market was looking very poor. That's the stock market. And there was every chance that there was an alternative, move money out of the stock market into the property market, if in fact you could carefully gear it and then make sure that the cash flow, namely the tenant base, was sufficient to service a 60% loan or whatever it was. So that was what we did. Yeah.
So you talk about. I've been privileged enough to hear about the story where the stock market was quite volatile.
Indeed,
in that sort of late 60s
and
that type of thing. So paint a picture for Melbourne and Sydney at that time in terms of population size. We're sort of, what are we, around 12 million, that high, or if?
Look, it was all half.
Yeah, half of where we were today.
Indeed, yeah.
And back in the day, tell us about, you would get in your Holden car and, the cities were sort of places where you'd go to work, but then they'd be dead.
Indeed.
5 o'clock.
Indeed.
And what sort of banking structure did we have at that time?
There was very little funding from the banks because they would lend money to owner-occupiers. They weren't, as investors were another group. But the point was, we reckoned that this money, this capacity to borrow money was an integral part of what would ultimately happen. And it was the solicitors that used to lend us the money for 3-year mortgages and 5-year mortgages, and then re-lend them to us or add a bit occasionally, but it was always based on the performance of the property and the value thereof, which would enable them to do, or the clients to get more facilities. And what we did, we set them up in such a way that what we're going to do is we're going to buy you a portfolio over the next 10 years. And it will probably work out to be 3 to 4 properties, and we will finance from your share portfolio, and then we'll finance further on the improved value, so that we were making a reasonable balance of opportunity occur in this concept. What actually happened in the end was the property business became so large that it swallowed up the equity business, only because it was a golden period where the stock market was looking funny, and the property market, if you could get into it, was great. But how did you get into it? And how did that work? And how was it that you could buy a property as easy as a BHP share and without too much trouble? So the trouble was, of course, that.
Yes.
How did you do that?
Yeah. Well, and we want to unpack that a little bit, but how did you get the confidence that that the property market was the place for you to pivot when there was all of this volatility? Because we look back now and it's like, of course you should have done it, but back then, I'm trying to get into your psyche back then around where that came from.
We really believed that this was an alternative method of investing, and there weren't too many people doing it. There weren't too many property advocates.
Well, you were a buyer's agent. Wouldn't even have been around back then. You were probably the first.
Didn't have the name. So that was a real situation. And what we did in our early stages, we actually bought a lot of houses. The question is, what, you bought the good ones and flogged the others to your mates? No, we didn't. But the point is, what we'd done, everything we did, we'd done it before personally. So it was our dough on the line as to and I used to say, if you don't like it, mate, we'll take it back.
Yeah.
So
it's a pretty good guarantee.
Yeah. Well, but the point is, we were also buying them.
Yeah.
So we were using the same attitude in the acquisition process, the ultimate buyer. So if it didn't work, we'd...
you were the safety net.
Oh, yeah.
So no bank wants to know you.
No.
You're doing solicitors' funds at around 60 to 66% LVR.
And that was as good as we get. And the solicitors wouldn't lend us any more than 60% ever.
There we go. And so there was a part of that secret sauce for you at the time. Tell us about what the importance of the income was in terms of that balance around that 60% LVR.
We were buying properties at levels which, after cost, it was capable of servicing the 60% break even.
So they were cash flow neutral?
Correct, yes.
Yeah,
that's what it was.
Yeah, cash flow neutral. So that gave the appetite for the solicitors' funds.
Yeah.
Tell us about when you're talking to customers, like property investment wasn't really a thing, right? Not in residential. As we said, everyone had a mindset that it was shelter.
And people were very frightened of borrowing money.
Yes.
They, what's going to happen here? What happens when the 3 years runs out? What do we do? And the answer is, well, we're not going to do anything about it. We're just going to, at worst, we'll extend the mortgage or roll it over. But if it's worrying you, we'll put it on the market and sell it. But that never came out because the clients were saying, in this concept, if you think I'm going to buy a slum property and have you manage it for us, you've got another thing coming. I said, well, look, it doesn't matter. The point is, what's going to happen here is what?
Yeah. So how did you overcome that when that paradigm around slum properties, I'm not going to buy it?
What they wanted to do is, we'd like to pay the mortgage off. Well, hang on, you don't do this. What we're doing here is we're borrowing other people's money to do the funding, and we're going to get rich as a result of that funding. Yeah. And that's the whole concept that we're doing here. Yeah. Now, people understood that but they didn't like it much.
No.
What happens if the $3,000 I'm owing on this? Well, it'll work itself out. That's what's going to happen. Now.
So just say that $3,000, everyone. Like that's what the mortgage sizes were. What were you buying the properties for?
Oh, nothing. $5 grand.
$5 grand. Now we're going to talk about this. So you're buying these properties for $5,000. You're doing.
That's bullshit. The cheapest one we bought was $7,500.
Oh, okay.
And then we bought a large number between 10 to 12,000. That's really what they have. And I've got some figures here that have just come out. We were buying these things that just because the figures worked. We could get the rent right, the mortgages right, etc., etc. And what do we do? We're buying heaps that people are going to buy and renovate and participate in a lifestyle change. That's what we were doing.
Jock, I'm fascinated by, because you tell the story now, and with the paradigm and with the benefit of podcasts and books, and everyone goes, of course, 10 grand, why wouldn't you have done it? But back then, it was cap in hand to the bank, you pay off, you never get into debt, pay off the loan as quickly as you can, and you're just nonchalantly saying to people, just as long as the rent covers the debt.
Well, that was the important part. The tender is the most important part anyway. So the management was very enormously important. So this mortgage had to be paid off, so the interest had to be paid on it, not paid off.
Yep.
So this was an integral part of the deal that we put this up for our clients. I used to say, well, if this is worrying you, take it out of your bank and pay it back. But for the time being, don't. This is how it's going to work, because we know what the returns are. We know how much it's going to cost to replace the property. But we know what the interest rate is. All these things, they're all ticking a box at every time. So it didn't matter too much. And when you talk about the longevity of us being in business or what it may be, the fact was that all those mortgages were 60%, and a large number of them came back to 15%. That's wrong, but the point is they had a capacity to continue to acquire more property. So the idea was on the concept of buying 2 or 3 properties over the next 10 years, and we'd gear them against each other and keeping the ratios about 60%. So none of these people are going to get themselves into any trouble, but as you said, Ben, they are richer than normal people.
Yeah.
So they're not.
Yeah, they were your clients that were coming out.
Yeah.
So they were a little bit more affluent than the standard new arrivals or the mum and dads of the day.
Indeed, yes, indeed.
So they had a better risk tolerance already to
a bit, yes, they did, and they couldn't understand why we were borrowing when they could pay the cash. So well, that's not the.
Can you walk us through? So let's just say I'm one of those clients back then, and you approach me, and we're going to the solicitor to get the lending. What does that look like? What's the mechanics of that? How long did it take?
I had arrangements with various solicitors and well-known mortgage solicitors, and they would give me. I'd say, I'll do the business with you if you provide us with the mortgage. And if you're going to charge us a procuration fee or whatever it may be, but that's how you and I will do business in the future. So if I bring a client to you, you're going to have the thing valued and you'll lend him the money. That's how. So we have an integrated legal system which provided the money for the.
And as you say, a lot of the clients potentially had a lot of the cash, so they had some wealth behind them.
Yes.
Because at the end of the day, most people who were dealing with stockbrokers in the late 60s, early 70s,
yes,
had a household wealth that would have been in the top 25% quartile. Let's just call
probably.
it that. Yeah.
And at that stage, a number of them took a belting too in the stock market. So it's suddenly, this game was a good one because what they'd lost here, they'd made up there. So it was an ongoing. So in answer to your question, the clients would come in and see us and say, here is a feasibility of what we've bought here, and this is what it's going to be, how it's going to work. And you haven't got a solicitor, this will be who your solicitor is. This is the bloke that's going to lend you the money, it was the same bloke.
And the numbers are all on the paper.
Exactly. And the fact was that all the solicitors were trying to further their mortgage broking businesses, which is great, and they were good at it. So, and again, they fit in with clients. They were referrals to us as well. So the system was tight. And the important part that clients liked was that we were buying the houses. Would you buy this? Yes, of course we buy this.
Yeah.
And there was
you
never
practice what you preach.
There was never ever over the 3 or 4 or 5,000 houses that we bought and allocated. There wasn't one that ever fell over ever.
Wow.
There was.
So, Jock, you've got an idea, right? And you're practicing what you preach.
Yeah.
So before you did it for your clients and you were doing it for yourself, why did you not go for the new house and land packages that were being built in the suburbs versus what you were looking for?
Because the land component was higher, and the fact that they were so close in, you were buying in suburbs where there were more people who want to be in the suburbs, and there is accommodation for them, whether they were tenants or owner occupiers, it didn't matter. We were being forced an underwriter like the Melbourne University, they were great. But then what we subsequently found that when these kids had graduated, they never moved out to the bloody suburb. So, but then they got good jobs because they were qualified, and they married the girl next door who had a similar degree. So the two of them start to buy these bloody houses. Yeah. Then they started to renovate them. Now, so what happened was these started to explode in value. My then problem was, how do we handle this? Because what's going to happen, these little buggers are going to move out of Carlton or wherever it is. Where are they going to go? So we just followed them. Yeah. We followed the students as they were pushed out of Carlton and Fitzroy into Brunswick, and then around. We did lots of South Melbournes and stuff, and we pushed them out to Coburgs, etc. So I would say, where are your students going to be? Where do you want them to be as far as the proximity to where they've got to be as students? And they would pick up the vibe for us. We did nothing. And it sounds wonderful that we were thinking how clever this was. It wasn't clever at all. It just so happened that was the dynamic. And these little graduates started the regeneration process.
Yeah, gentrification.
Absolutely, and they had the dough too, because they were getting bigger salaries than you and I.
Yeah, but you weren't. You obviously, this is what I love about you. You're very humble in sort of saying that we did nothing, we just follow. But by identifying that, but also you identified the yield curve in there in terms of the property being neutral, which gave the customer confidence to actually do that in the first place, and so. When the market's moving and the gentrification, and we call it the ripple effect now, right? It's got a name.
Yes.
All of that was coming on because of the changes that were going on and the wealth that was being created through the university and those kids getting higher income. So I think you were onto something there, both in Sydney and Melbourne. So can you just tell us some of the suburbs that you were buying in early in both Sydney and Melbourne?
Well, certainly in the Fitzroys and the Carltons, that was on Monty, and the Brunswicks, and the North Brunswicks, etc., and the South Melbournes and the Albert Parks, because I lived in that, and I thought that if we could buy all these things in Albert Park and South Melbourne and Port Melbourne, we'd be rich. Yeah. But we couldn't do it because we couldn't tick the boxes in the end. And I still use the same basis. How much for this joint? What's the rent? If you can't, I can't make it. Can't make it work. Yep. Now, the current situation now with interest rates where they are, it's just a dynamic which is quite bizarre. And the point is, when you're buying the houses now, they're 30% below replacement cost. Why would I buy a house that can't already be built? Why would I do that? Because the fact is, you're buying existing stuff which can be improved. Not only that, it can buy another coat of paint. You could add another $10 a week on the rent or whatever. But a recognition that in the ultimate form, the property will always be underwritten by an owner-occupier. He's always going to be the bloke that's going to beat you at the door, and he's going to move into it. So he just moves the. So the other answer is, where was it in Sydney? We were Paddingtons, Newtowns, Enmores, and lots of them. In the last 4 or 5 years, we would have bought 200 properties up in a metropolitan Sydney, 2-bedroom, double-storey, renting it $800 a week, and we're buying them for not much.
I reckon, hearing some of these stories, and I've chatted with Ben before we push record, I think your career, particularly early days, were probably best summed up by swimming upriver, because it would have been easy for you to swim downriver,
Yes, that's true.
I mean, you were encouraging people to lend when it wasn't normal.
To
you
borrow,
were encouraging people to borrow for investing when that wasn't normal. You were encouraging people to shift from equities to property when that wasn't normal. And then, if you tell that story, anyone who's listening now who knows those suburbs that you're talking about. I mean, Albert Park is probably close to one of the best suburbs in the world, given that Melbourne's always one of the most livable cities in the world.
That's right.
But back then, everyone was packing up their cars and driving out to the burbs to put a picket fence around. And again, you were swimming upriver to stay in some of these workers' cottages that weren't popular back then. Whereas now, they are a no-brainer, and people are trying to get as many as they can.
They were artisan houses, weren't they? Where the people were doing leather work in Collingwood, and so the whole dynamic changed, and that had to. We could see that was what's going to happen. These little terrace properties, which are tiny, but they are individual. There's not a body corp in there or owners corporation, etc., etc. And so it was easy to work out, what's going to happen when this thing burns down, and they don't. These Victorians. But the point was, it was always a concept that this eventuality. So buying in these crappy suburbs was very important, because the replacement value of even in some of the places now, you're buying this stuff. It's in Geelong for $500,000. The block of land's worth $350. You couldn't build a shack for $100,000. I promise you. That type of game.
People say land appreciates, buildings depreciate, which is an accounting concept, and it's kind of true. But the reality is, even though buildings depreciate on paper, they actually do appreciate in reality. It still costs you more to actually replace it and build it, but the principle is all the values of the land.
There is a concept there that says, as long as you keep spending money on the house and pushing the rent up, you're okay, because you'll keep the tenants. Exactly.
What are some of the observations that you've seen shifting in Melbourne? Like we've touched on a few, but if you look back to when you first started, and then now what you see on the landscape, more high density and a change in the way people live, what are your observations, and what does that mean using the benefit of your experience for what you see in the coming decades?
I think the off the plan unit development is going to be a dangerous game anyway. I can't see, because there's no land component in them and do provide accommodation, but I can't see people wandering around in 50 or 20 years to say, we should buy this one. I can see them going into Elwood to have a look at those blocks of flats in Art Decos. Now, that's a different game. You've got a different dimension in size and volume. But I can't see this game of buying and building accommodation such as the off-the-plan unit. I've never bought an off-the-plan property in my life. That's rubbish. We did bought a few, the ones that were now 20 and 30 years old, but at the time they couldn't give them away. So how is that going to work? How do we rationalise this acquisition? And it's always the rent and the size of the land and the cost of the money. And if they don't do it, we can't play the game. So if I answered your question,
I mean, in a sense, it's just you still have that underlying confidence in the land value, and you don't really want to put faith in, because really, when you're buying apartment, you're buying airspace. You're not actually you're actually buying a small unit entitlement to whatever the land it sits on, but you can't sort of point and say that it's mine.
No.
So you're buying airspace, and given that we are going to have bigger densities come into this country, I see that demand will be underpinned by that going forward, but I still think that for people who want to have records like what you've got, where over a period of time you've been very successful in getting good outcomes for your clients, we have the same view as you, that the more land value that we can get, and we've helped clients buy in small, older style, like you talked about, decos.
Yes.
But this podcast in our community, we are very much guiding them away from not even just off the plan for a living space in those high densities, but also because of a lot of the tax that comes with it. If there's any challenges, some of the financial costs in maintaining these things, what if something goes wrong? We've seen some high profile cases around that. So I think we're in alignment. I think I probably knew what your answer would be.
Yes.
But it's always good for our audience to hear.
I'd love to think that there were opportunities out there. And they're not. But the ones that are of a volume component, and they are houses or units that people like to live in. Sydney is rotten with them, but they have a value because they are capable of being negotiated, as distinct from off the plan, which has no negotiation for the first 3 or 4 years. There is anyway, but.
Yeah, no,
So
the spreadsheet determines the price, not
yes,
not market
indeed.
forces.
Exactly.
Jock, with the almost 5 decades of doing what you do, it's incredible to learn. You started effectively an industry that didn't quite exist. We did see through the 80s this whole concept of self-funding retirement. Now you've been also through the heady 80s of the bonds and the SCASEs of this world. I mean, you've seen a lot, right? You've seen oil crises in the 70s, you've seen floating of the dollar in the 80s, you've seen this excessive debt stories with bonds and the SCASEs, you've seen, effectively the recession that we've had to have. But in the property space, I want to talk more about, you also saw the introduction of the spruiker, and they are obviously doing the off the plan and the house and land packages. So I'm sure on your journey, you would have had a couple of builders or developers knock on your door and say, well, why can't this work for house and land packages? Not so much we've covered off the plan, but why did you say no to those builder developers who are talking about building houses or townhouses in the burbs?
I suppose it was more arithmetic that I couldn't see the margins. I could see that they were coming in with buying the block of land, putting a 30% margin on something that they'd bloody sell later. Yeah. I couldn't work out the bricks and mortar and the land as a component of the deal. So if I thought it was a good idea, I would have done it myself as a developer or builder. But I couldn't see the margin in it because there was always a problem in the last 10 properties. Didn't make the cut, and therefore I could have bought these bloody things from the bank at the time as they were winding them up. Now that's not Harry Triggerboff country, but it's the same story. I never bought anything from a builder, and why is that? Well, I was too lousy to pay the margin that I knew, but without doing it myself.
Well, there was nothing in it for the end investor, was there?
There wasn't.
So you took your principles from stockbroking.
Yeah, exactly. And so the existing stuff was always going to perform better than anything else because it had an appreciated value, and you and I couldn't replace it anyway. Yep. But as it stood, it had this underwriter issue there where there were more people that wanted to buy a terrace house or a close-in single dwelling of historic consequence. And they were always going to be there. They call them now retirees. And they're these things at $50,000 bucks, and they're knocking off 2.5 million for these little joints. So that was recognising this would happen, and this has happened in Carlton, and it has happened in Footscray, and it has happened in East Melbourne, and it's happened in Jolly. It wasn't as though this was a game, because it was easily seen in the Sydney market. The Sydney market was always a field like that, and we found that when we were buying in Sydney, suddenly there'd been a change. It's a very funny market, Sydney. When it's down in Melbourne, it's up in Sydney, and that's what's happened. We were buying on yields of 5% in Paddington. This is in the last 7 years. This is ridiculous. Buying here, we're buying, if we're that lucky to get 3.5. How does this work? How does all this? It does work because it's a market-driven scenario, but what I'm saying is that the opportunities to buy this type of stuff hasn't left the station yet.
Yes. So you're saying that you can find these high-yielding locations where you're buying counter-cyclical to the market and looking for that yield to come in, but also looking at gentrification, also looking at the fundamentals, proximity to the city. Yeah. So it's the combination of the buyer's decision quadrant and all of the sort of stuff that we say about the practicality test in terms of that. Now, where did all that stuff come from? It's all come from sitting down, talking to people like Jock and Scott Keck and even people like John Edwards. They are the types of people who have had the thought leadership and the observation, because you've seen these properties that you were buying in the 70s for $10,000, now be worth over $2 million.
Correct, yes,
in those
yes.
locations, right?
And therefore, give me the rationale as to why I should buy it as an investment, and you're not going to be able to give me a yield more than 1.5.
Yeah.
It's not a game. So, but it's a very important value game that justifies why we can do it. Now, as I said, that business of dudding the houses up for the university students, well, there was a quid in that. That said, it's going to cost 20 grand to do this. Are we going to get a 10% return on that? Probably not. Yeah, a $40 rental. Yeah, well, that'll happen. Oh, well, that's a good idea. Now, but the point is, all that game could happen after 12 months, where you can offset a certain amount of this repair work and have it qualified by a rental increase on the deal. So there are always nice things to happen in this.
And importantly too, when you did that the university game, you still bought houses that had
yes.
broad general owner-occupier appeal.
No question, yeah. Always,
that had the tenants were students, because a lot of people get into trouble when they chase the student accommodation pathway when it doesn't have that universal owner-occupier appeal. It's purpose-built, they're chasing yields, and all of a sudden it goes pear-shaped because...
How are we going to sell this unit that is part of this university letting market? You can't, and you won't.
No.
So the point is, the capacity to do this stuff is enormously important. So we start by not trying to get involved in that type of stuff.
Yeah.
And we never have.
Now you're talking about, I mean, you mentioned the word, that you're buying these slums, right? But they were workers' cottages predominantly. They were the lower...
artisan cottages. There were blokes that would live across the road, the leather factory in Cambridge, Collingwood. That's where he was. Or he was making malt in bloody Barrett's or something.
So they're not necessarily house proud. Let's just say, I mean, they had running water and everything was all well. They were structurally sound, so you weren't being slumlords to those particular people.
But that was the issue. That how do you elevate the calibre of your tenant?
Yeah.
So, in the early stages, I wouldn't walk into Fitzroy after dark. Yeah. Really nasty place.
Now, people listening to that today are going, "Oh my God!" Back in the day, compared to the gentrification that's gone on there.
And therefore, the capacity to buy these old shacks, they were there all right, but the question is, how do you fix them up to a level where there's a nasty tenant in there that you've got to threaten to get your rent? So that was why I pushed the university button. So we will renovate these joints to whatever level you say, to have you, that got rid of the problem. So it was an easier, the scenario was that to buy into some of these places where there were nasty people, if you're going to let them, you've got to have it covered. Otherwise, they'll cover you.
Yeah, no doubt. Yeah. You talked about, before we pushed record, you were telling a story about how you went to Melbourne Uni and got them to underwrite that. Now that we are recording, can you retell that story? Because I think it's beneficial, because you segued into it just a second ago.
Well, the fact was that we were buying inner metropolitan houses, Carlton, Fitzroy's, etc. And we went to the university because we were worried about the likelihood of proper tenants living there, namely the kids of whatever they were, whose family were paying the bloody mortgage, university fees. And so we figured that these kids were responsible. They're there for a purpose of getting a degree. So they're not going to smash the houses up too much. We had an arrangement with the University Student Housing Authority that they were going to have a look at these places, apart from the normal inspections that we would do. So it underwrote our capacity to make these decisions. Here is a tenant in a property, a university student, and they're not whackers, they're kids that are trying to get a job through, a degree through the place.
So was that a handshake? What are those like?
I suppose it was a handshake, but I used to throw every property at the Melbourne University housing system.
Okay. And so there was a representative there, and you used to say, "Here's another one.
Here's another one." And they tried to screw us down on the bonds, They only want to pay 3 weeks, not 4 weeks. Okay, well, if that's what you want to do,
Or
that'll do.
possibly.
Okay.
Yeah,
It's a guaranteed rent. Now, when did that run its course? I mean, today you're still probably not doing that, you know.
Well, I can't get $1,000 a week from a student.
Yes.
It's true. True. Times have changed. That's a very important point.
Well, the places have changed, and that was the point that I made. That where were they going to go?
Yeah, we followed them around.
Where will you? And we would follow them. There were RMIT students as well, and Melbourne University or tertiary colleges. We did the same thing in say Frankston with Monash. We did the same thing with Footscray, with the university. So we had these arrangements on foot, and they in themselves were all designating where they wanted to live, and we just followed them.
Yeah.
Because the same thing would happen. It was a good guide, and the calibre of the tenant was always not bad.
You raise a really good point, because a lot of people buy properties and they focus on growth and yield, which is textbook, right?
Yes.
But the other two things, and you've been doing it for 40 plus years, but a lot of people need to learn the lesson that you've done, is it's not just about growth and yield. There's 4 things. It's growth, yield, the vacancy rate, and 4th is the quality of the tenant.
Correct.
And people often overlook those last 2.
He's the most important aspect of the deal.
Yes.
The tenant is...
But you can buy in a really great suburb that has fundamentals that stack up pretty good, but in that little tiny pocket of that suburb, you won't get yourself the best tenant, even though at face value it's like, surely I'll be okay. The vacancy rate for the suburb's all right, and I'm in a really great suburb. But if you, like you say, if you don't focus on that particular pocket and not being able to get those really cool tenants over here, that can undo all of the good work you've done.
The point is, what happens in an elevating suburb, the values go up, all right? But they're much more difficult to let, because there's only a normal number of them. The values are all okay, but you've got to be buying in suburbs where there are more people wishing to be there than there is accommodation for them. It's as simple as that.
Supply and demand, and that's whether it be owner occupier or livability for young millennials who want to come closer to the city to have the action. They'll happily pay the rent if they need to, because it's got to have the lifestyle drivers attached to it.
See, with the COVID issue, Geelong is a classic situation where the place went broke and suddenly things changed a bit and people started going down there. They like surfing or whatever the hell they do.
Oh, who would do that, seriously?
But
Anyway.
the point is they can work in Melbourne, catch the train back. They've got a 3-bedroom house in Geelong, which is no bad. Nothing to. They can drive out. And that all works. And we're buying for 30% below the replacement, and these things just work.
Yeah. I'm that guy you talked about. I live in Torquay, and I commute into. But I've seen a lot of people on that train who are getting a lot of work done on the train.
Yeah.
So it's changed. Can I ask a question? I'm super interested in at what point in the timeline of this journey between now and when you started did it pivot from the 60 to 60% deposits with solicitors to then moving towards 80% funding from banks, and then obviously using existing equity to get 105%?
Yes.
Because the context of that is, I'd like to know how your system worked back in the recession we had to have when interest rates went up to the high teens, and your strategy is to make sure that cash flow covered costs.
Correct.
Clearly costs were pretty high back then.
They were, but partly the decision was, are we going to sell this? And I said, well, wait a minute, I'm not too sure about that. Well, how are we going to hold it?
Yep.
What's the retention issue here? So we were very mindful of the underwriter or the owner-occupier, or who he may be. His exercise couldn't trump the necessity to cash or have cash flow on the same basis as we had before. And that blew the game out of the water. You couldn't what I'm finding now, for instance, is I've got clients with these houses that they're saying, we've got a 30% mortgage or a 50% mortgage. I said, well, go and buy another house.
Yes.
And that'll be better than 1% in the bank.
Yes.
And it'll do all the things that's happened in the past. Historically, this is what's going to happen here again. Oh, we're a bit old. Well, hang on. You're going to go broke if you don't do something. And if you're playing in the game that you've done in the past, why wouldn't you keep on playing?
Yeah. Oh, things have changed. Surely it was the golden era. Property's never going to go up again.
Look at that. Look at that business with interest rates now. What an amazing game that is.
Yeah.
You can buy lots and lots of stuff, even the traditional stuff that we've been looking at value. And will continue to be so if those interest rates. But I did one stage when we did a lot of managing for other clients' properties, industrial and commercial properties, because I had them and would we do it for them. So we did a lot of that stuff. But the point was that they didn't perform as well as the residential
The
markets.
commercial stuff, no.
And so those people are saying, now that I'm in retirement, what are we going to do? Well, play the same game. You didn't this advantage hadn't happened yet. Oh, well, maybe that type of stuff. So,
I mean, one of the interesting things is you didn't have capital gains tax
absolutely
up until 1985.
correct.
So,
and how that just worked like a dream.
but here's the important thing: you still held on to a lot of those properties, which is one of the final points I wanted to ask you. I've got a couple more to go, but you looked long term, even though you were buying properties that were pretty much covering their own. You still played the long game.
Yes.
So you were looking at what were those attributes, or what were the things that said this is a long-term investment, as opposed to being a stockbroker. Did you take the same type of value investing approach as you did as being a stockbroker?
As a stockbroker, we were driven by commission.
And that's turnover.
It's turnover. If you're playing that game in the house market, that's very expensive. There's by the time you've played a bit of capital gains tax and a few market etc.
No good.
So you've got to stand back and say, well, wait a minute. The long game is the only game to play in the property market. And as long as you can see that there's something going to happen down there because the suburb will move or property will move in whatever, that's why it's always been the best deal. I don't mind paying capital gains tax if in fact if it's a proper game, but the point is it's taken you that long to make the serious capital gain on which you're going to pay the tax. But I'm not sure I'd be flogging an existing property to buy another one elsewhere. I'd refinance this property to buy another joint, whatever it is.
Don't sell the goose that lays the golden eggs.
And just play the game.
Yep. You also talk about 3-4 properties. That seems to be enough for most people.
Yeah, about right, yeah.
Yep.
We've got people, we've bought lots of them, 5 and 6 and 7, 8. And the question is, what do we do with them now?
Nice problem to have.
What's your answer?
I said, just borrow some more. and just go on the current rate of interest.
My final question for you, Jock, and I've really enjoyed the conversation we've had, is from the point of view that you have now, and going back to yourself back in 1967 and redoing the journey, would you do it exactly the same? And if yes, great. And if not, what would the tweaks have been along the way if you got another shot?
I believe that it's been a successful scenario and
the intro
and
confirmed that.
Numbers speak volumes.
But the problem is, where are the opportunities now? See, if I'm ticking the boxes, I can't do it. I've got to move on. So I bought 200 or 300 properties in Brunswick. Now that was a hell of a good deal. But the point is, I can't buy them now at $1 million because I can't get the return. But I might move somewhere else. But the question is, do you want to sell this property so you can buy another one. Well, hang on, this is a very expensive exercise here. This is capital gains, this is all this. So what I do, I would have to have thought out the capital gains issue. I would have to thought out the interest rate issue, and the underwriter, he's the unknown component. He's the bloke that is going to buy it from you in the end and live it in it as the tenant and the underwriter or the owner they're both serious components in the exercise. And as long as you've got those 4 points working for you, the cost of the money and the tenant and the value of the prop, etc., and demographic and the social implications of what's happening in the suburb. That's,
well, we say, Jock, that basically the owner-occupier is the price maker, and then the investor should be the price taker. Like if you think about it over the long term.
But if he wants to continue on as his investment scenario, he's got to borrow himself out. I think.
Yeah, or retire the debt based on the positive cash flow that eventually materialises, especially, like your clients who got down to a 30% loan to value ratio or 15% loan. Yeah. I mean, that is just spitting off cash, in terms of, and ultimately, as you say, what do I do now? Well, you've got a multi-million-dollar property portfolio and you've got a passive income.
It's called hashtag lifestyle design.
That's right.
Learn golf or something.
Yes. 1% on 20 million is not bad, or something.
No, very true. I don't mind paying the tax when you've tripled your money over 3 decades. My last question, and then we'll close it out because it's been an amazing chat, and we appreciate your time, Jock. Main roads, compromised locations in blue chip areas. You've been able to watch the market and analyse busy roads or compromised land or irregular land. What's been your observation, and would you have bought those properties or do you steer clear of them?
I preferred not to buy them because we have.
Yeah.
And because they are where they are, they rent all right. Mm. But I can't see my driver as to where am I going to get the capital gain unless in the street there's a zoning change or there's an accumulation where people are going to build properties next above. But the traditional property on a reasonable block next street back is where I'll go. Unless there's a story there that I could.
Well, hence what you're talking about for the rezoning for the benefit of the community listening, you're talking about the productivity of that through rezoning, i.e. you could build a group of sort of high-rise, 3-story high, mixed-use zoning, so all of a sudden that land becomes repurposed and it might get a capital gain out of that as opposed to,
and that's a punt that you can't take in the market.
Especially when you're playing with other people's money.
Indeed.
Terrific. Yeah. Now, Jock, I just want to round out by saying, mate, thank you so much. You've been obviously someone who I've admired and got to know over the journey as well. You have been a trailblazer. Your business and what you've set up, even though it was for, as we talked about originally, probably high net worth people, time poor professionals, what you've been able to do in terms of developing out that business has let businesses like us come in. The industry has matured. We still have some unregulated, sort of stuff going on. And so we've got some spruikers and some people who don't have the self-interest, but you've led a purpose business. You've changed people's lives for the better. And I can't thank you enough for obviously sharing what those lessons that you've seen over those 4 to 5 decades of playing in this space. So thank you very much. It certainly, from my point of view, what you've trailblazed is allowed even mum and dads and people potentially on lower incomes. And it's also matured in the sense that everyone thinks that you're just after capital growth. Well, some clients, they do need to potentially, if they want to buy bricks and mortar, they potentially need to, based on their cash flows and their buffers and all of that, they do need to go for maybe a yield property first or a balanced property first as opposed to those growth assets. So, businesses like ours can now provide tailored solutions on the back of that, but not because we just guessed that. We basically looked at businesses like yours and the work that you've done, the work that John Edwards and also Scott Keck have done over that journey, and allow more Australians to potentially self-fund their own retirement. So I just wanted to thank you very much for that, and congratulate you on an incredible career in terms of changing people's lives.
Very kind, very kind.
Hear, hear. And I think the wisdom that you were able to share through the last sort of 45 minutes to an hour is going to be an enormous benefit to our community. So I echo what Ben said, and I also thank you for coming on the Property Couch. There you go, Ben. We had a masterclass with Scott Keck.
Yep.
From the valuer's point of view. We just got a masterclass from a buyer's point of view. And as you said, when buyer's agents weren't around back then, and as I said during it, just a career of swimming upriver, which most of the advice that you listen, yeah, that makes sense. Buy properties. Oh, buy them in nice and close. Oh yeah, just go to the solicitor and get some fun. Like, sure, no problem. But back then, that was pioneering stuff. It was against the grain, and what an incredible opportunity for you and I to be front row, and of course our community to be fly on the wall hearing that conversation.
Well, I remember meeting Jock and getting his research in terms of that independent analysis done, and it sort of validated a lot of the lessons that I'd observed myself. As I said, going to all of those events. So to know that land appreciates closer in and ripple effects out. That owner-occupier appeal is an important, what does he call it? The underwriter. Those types of lessons. Cash is still king in terms of keeping you in the game. So it's all the stuff, we have different flavours on it, and the fact that, these days we are now able to not only tailor solutions just to, potentially higher net worth people, that he was able to do that for, that to see that individuals can have a go, and couples and households and mums and dads can have a go. It's all on the back of trailblazers like Jock. So all credit to him.
60% LVR, Ben. That was navigating those days. It went to 80. Then of course he's now part of the 105% brigade. But look, I like you want to just shout out again to Jock to say thanks for taking the time to come in here and share the wisdom. Hey, my life hack for today is Ben. I'm usually trying to set these life hacks up.
Oh, yep. Here we go.
In a way to benefit the community.
Yep.
Right? But I thought I haven't done one for you for a while. Right.
Oh, okay.
So this is a life hack for you. So are you ready for this?
I'm ready.
So I'm going to set the scene. Thank you, Ivis, for coming in close.
She's trying to see my facial expressions.
She's appropriately socially distanced. But so Fremantle Football Club, right? So let's set this up. They're a minority team in a minority town. With none or very little go-home factor, right? Think Buddy Franklin, great West Australian, never entertained the thought of going back to Western Australia, went off to Sydney. So story after story after story.
So not an attraction destination. Is that what you're saying?
Have you been to a Perth beach? Have you lived the Perth lifestyle?
I have a beautiful Perth wife, mate, or a Western Australian wife.
Well, you shouldn't be saying stuff like that because there's lots of attraction over there.
Let me explain. You were talking about it.
Get in Perth, folks. Right in. An attraction
destination being Fremantle Football Club.
Yeah, I set you up for that. It was fun. I went tangential, but it was nice. So we're not a destination club like Geelong. Right, so Geelong's the #1 destination club. I used to think Collingwood was, but no, Geelong is the #1 destination.
Everyone
club.
wants the coast now.
They want the coast.
Now that COVID.
They want to put the fishing line.
Yeah, they want to be able to go down and fish.
Fremantle has a long plane ride every second week, so making Matthew Pabbage probably the greatest of all time at 300 plus games flying across the country. So the point of that is that Fremantle, from this side of the country, it's not easy to follow them because of some of these circumstances, right? Mm-hmm. But surely we've got to be a better place to be than Collingwood right now. Seriously, what on earth happened to your club this week, mate? I'm trying not to smile, but it was
not trying at all.
It was hashtag Collingwood's so trollorable. What happened? Come on, mate. I'm going to help you out here. Look, I did a little bit of research for you. So the point of bringing the Fremantle is clearly Justin Longmuir was the person keeping it all together over there. He's left.
At the pies.
It's gone pear-shaped, right?
Okay.
So therefore, you might want to write this down. www.fremantlefc.com.au. You can get your membership now. And just I've done some research for him, right? signs you're a Collingwood, because we know what's coming, right? We're about to hear the, I'm proud of the boys, so we're about to hear all that. But signs that you're a Collingwood supporter. 1, you're still banging on about getting ripped off in the 1980 night grand final. Number 2, you lament the advent of colour television. Number 3, you don't get the dentistry jokes. Number 4, October is your favourite month of the year. Number 5, September is your least favourite month of the year. Number 6, you don't think the term collywobbles is funny. Number 7, you keep a tally of how many goals can be chalked up to the umpires. Number 8, you like to live on past glories. Number 9, you call out, have a shot, when one of your players has the ball in the centre square. And number 10, Ben, every event in your life is recalled by its proximity to the 1990 or 2010 premierships, Ben. So my life hack today is that you should consider maybe swatching.
Or maybe the other 14 premierships, or just those 2?
My life hack today is you should consider maybe whether it's time to switch allegiances and maybe follow a team that's on the up. Because seriously, I'm ready for it.
You ready for it?
Yeah.
All right, time will tell.
Okay, time will tell.
Time will tell. I mean, it's very difficult, isn't it, to not know what's going on, to be an observer.
It's very difficult. You're right. What is going on?
Well,
salary dump.
Well, yes, maybe.
Yeah.
Or maybe it is, that they're trying to get better, and it is brutal. I mean, it is brutal, mate, in terms of what they've had to do. Brutal. So,
Ben, www.fremantllefc.com.au. What's making property news?
So, Bryce, what's making property news? Oh my God. OMG. We heard a little whisper about what was coming, but it actually was released on Tuesday with the State Treasurer of New South Wales changing the game. That's right. We are talking about complete reform to stamp duty. Now, just quickly, this is great news for people who are trying to get into the market, because it means you won't have to save for 2 years to get a deposit. But we're going to take a deeper dive into this, Bryce. It's such big news that next week's show, we've got an exciting show with a special guest, but we're also going to take a deeper dive into what does this mean, because there's still a lot of information. There's going to be a lot of questions. So we want to take a bit more time on it next week.
Okay, mate. So that's exciting. Look forward to next week to unpack that with everyone. But what's making property news for the rest of this week?
A couple of big news stories. ANZ scraps its too pessimistic house price call.
Oh.
So they've changed their forecast.
Come on.
From a negative 10% fall to now a pretty robust fall, where they see Perth likely to jump by 12%, Brisbane by 9.5% next year, Hobart by 9.4%. Sydney property prices are expected to rise by 8.8%, and close to the national average. And Melbourne's going to lag at only 7.8% growth in the course of the next, their new forecast, their revised forecast. None of these 40, 30, 20% drops. It hasn't even got to 5%. And just to back that up, Bryce, I've just pulled up the latest data from our great friends at CoreLogic in regards to the change in their hedonic pricing index. Here we are, Bryce, latest weekly change. Sydney is up 1 to be up. This is literally from last weekend, right? This is pretty hot off the press. So the monthly change in Sydney is now +3 for the month. Melbourne is +2 for the week. It's already +5 for the month.
Oops.
Brisbane is +1 for the week. Brisbane is +5 for the month so far. Adelaide is +2 for the week, +9 already for the month. Basically, there's still 2 weeks to go till the end of this month, and they're already so they might have a 1% month. That's crazy.
Well, it's if they can keep the cluster under control.
Well, true. There's a little bit of sentiment shift there, but I think people will still buy properties. Perth +2 for the week and +7 for the month. So just goes to show you, I think not only will Westpac be changing their forecasts, I think CBA's already done it, and Westpac sort of moving their forecast. Everything else I love about Bill Evans' forecast, except for his property story.
Are we going to change our forecast from when we were back in March when we were predicting doom? Oh, that's right. We didn't predict.
No, we predicted by the end of the year that property prices would be growing.
Yes.
Looks like we're a bit late to the party. Looks like it's going to be, it happened already nationally.
We were in the thick of a pandemic when we made that call.
Now every capital city is going to have property prices growing by November. So a good result there in terms of what we're seeing around that particular story. And I just wanted to round out, some of, I did mention Jock's data, right? When we were talking about that, and I've got one property that he bought back in 1972.
Right.
on Thompson Street in South Melbourne.
Yes.
Nice little single-fronted terrace.
Yes.
Probably 6 metres, 6.5 metre wide.
Yeah.
He bought that property in 1972 for $9,200.
Oh.
Yeah, I think it's done.
Didn't
I think it's
negotiate
done right.
hard, did he?
As part of the review that he did with Charterket Kramer, revalued in 2003
Did it
for
go up?
$420,000. Just a lazy 13.7%
Oh, gee whiz.
capital growth return.
Yeah.
Not bad for some. Now, of course, could have been renovated, so there could have been some tidy up in there.
Yeah.
Got to factor that in, but you're not factoring in that sort of number over that sort of period of time. So well done to Jock and his team for the great work they did and the trailblazing they did early on. So that is what's making property news, Bryce.
Very good, thank you, Ben. I appreciate that. So what a action-packed episode that has been. I said it at the top, I'll say it at the bottom. I love talking to people who've been in the game for a long time, Ben, because they are not fly-by-nighters, they are not fly in the pan, there's not get rich quick, it is get rich slow, and that is what our podcast is all about, get rich slow. So it's nice to have some of these principles reinforced. So
building wealthier tomorrows.
I like it, Ben. So nice one. Until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Very well said, Ben. See you next week, folks. Hey there, folks. Bryce Holdaway here. Before you go, if you're new to our community and only listen to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.